So I think 9:15 is a more appropriate time for starting everything to do with markets. I must admit that when we were up this year in terms of deciding what the theme of the conference should be, and the carnage that we saw in September and October, we had our own thoughts in terms of whether will there be any theme left to discuss this year. And therefore, we wanted to put our heads together to say if we are discussing what it looks like over the next 6 months, 9 months, 1 year. And India is, I had a friend of mine who's been born, brought up in the US, and strangely for the first time he came to India when he was 25 or 26. And he went to 3 different parts of India. He went to UP, and then from there he went to Bengal, and then came to Bombay, and he was meeting friends here. And he was stunned to believe or think that this is actually one country with such diverse differences of people, economies and geographies. And I was only telling him, had you stayed for 2 months in India at the stock market in September and October, then the experience of that diversity for you would have been much higher. But he joked in return and said that don't worry, if you have your demographic diversities that you talk about in India, then we also have our Mr. Trump in the US these days. So we also have extreme diversities of the market depending upon his moods. So I'll quickly, maybe in 5 to 7 minutes, tell you why we thought this theme was more relevant for us, connecting growth. We wanted to start, you can't start a conference without a quote from Warren Buffett. And I was telling Jemit, if you want to use an India example, what do we do? Because he said that Wall Street is the only place that people ride into a Rolls Royce to get advice from those who take the subway. I wanted an Indian example, but Jemit made me believe that the subway in Bombay will have to be replaced by metro. And we still have maybe 1 or 2 years more to take that example in Bombay, and therefore we stay with a US example. And this is the universal truth of all stocks. We have to remember that all that goes up goes down. And we must admit that we've had markets over the last 2 months which have been ridiculously crazy. I spent quick time on this. Of course, we know that the basis of the theme is because of 2 or 3 main factors that we think are playing around in the markets right now. And I'll move quickly to say the PE charts, if you see between the mid cap, small cap and Nifty, we saw the divergence during the time when Nifty was at 11,000, 11,500. Reminded of old times of 2008, markets were not as leveraged. But the big issue or big difference was that the P multiples of the mid cap and the small cap were running actually far ahead of the Nifty 50. And all of us at that point of time knew that there would be correction in the offering. We seem to be at a point in time where that divergence between the mid cap, small cap and the Nifty 50 seem to have reconciled and come to a common place. So it looks like a great opportunity at this point in time. The diversity between what we were worried about, the divergence between the mid cap, small cap and the Nifty seems to have corrected. So in light of that, it looks like an opportunity, but there are other factors that are important to look at. If you look at earning estimations, expectations are high. And let me run quickly to say that we think there could be a reasonable number of sectors where for financial year 19-20, we think the estimates of earnings could be growth rate of higher than 20%. So we seem to be in a situation where the divergence of the mid cap, small cap and Nifty is corrected, which is very good for the markets. We think based on consensus that there are a good number of sectors over the next 1.5 years time where you'd see a growth rate year on year of 20% plus. So it's a good situation to be in. But how constantly do we see this? The textiles may be up and chemicals may up and power is up, but the bad news that you don't have any in your stock. So we've seen that kind of problem today where it's important to know at this point in time that if valuations look cheap, if I may use that word, if Nifty at 15 times forward right now and correction between mid cap, small cap and Nifty 50 having reached to what levels we want to, it's important at this point of time to be able to pick the right kind of stocks and more importantly the right kind of sectors first that we think will get momentum over the next 1 year's time frame. And we mustn't forget that amongst all this, the other big factor is the 10-year yields. Now you look at the 10-year yields in India, you look at 10-year yields in US, they all seem to be moving up. And at the grassroots level, there has to be a difference between the bond Ps that you see and the equity Ps that you see. If bond yields go up, and 10-year we are seeing going up, it obviously means that cost of capital is going to be higher. If cost of capital is going to be higher, that's what is used to discount the cash flows on the equity market for the future. So the delta between the bond yields and the equity market are correlated, and we seem to be in a situation where that seems to be at an inflection point. The only point that we are trying to make, that valuations may look good at this point in time. There are sectors which look like will outperform, and that's important to spot at this point of time, but overall market doesn't seem to be in a hurry to run away. So if the overall market valuations are going to be range bound, the important point at this juncture is to say, what will you pick? And if you pick something which will make sense for the markets 1 year from now, they have to be growth-oriented companies. And the whole reason why we focused on saying whether it's mid-cap, small-cap, or the focus needs to now shift in a market like this. I understand there are too many variables which will play out over the next 1 month to 6 months kind of a time frame. But in a given context like this, with the market the way it is at this point of time, we thought it is most opportune to pick a theme which will play out over the next 12 months, and that's the whole basis on which we are doing this. So spread between 10-year, I'm rushing through this to make sure that the whole sense of what we are, the conference is on about was what we were trying to cover. So we are saying if we connect growth, why look at growing companies? It's important. Valuation of growth stocks have moderated. The earning growth that will come from different companies is going to be the key for what we will spot going forward. That's the difference in 2017, 18 and 19. So it looks like anything that ran in 2017 questioned in 2018 and maybe a reasonable laggard in 2019. And therefore it's important not to go with the flow of what happened in 2017 and 18 for the next year in 2019. And therefore bottom fishing is important. And if bottom fishing is important, then you need to pick from what you need to look at as far as the markets are concerned for the next 1 year's time frame. We thought it's opportune at this conference of Kotak to discuss not essentially mid-cap or small-cap, but within the same space of mid-cap and small-cap, the growth-oriented companies, and that's what we need to watch out for. So ladies and gentlemen, that's the reason we thought the theme of this conference should be connecting growth. I'm happy welcoming all of you here over the next 2 days' time. We hope that we provide you access to the companies that we think will basically, based on this story, based on this movement that we'll see over the next 1 year's time frame. Welcome all of you, and I hope that you have a great next 2 days' time. Thank you.